San Diego, you guys. All right. Raise your hand on what chapter you're from and tell me your best part of today. Go, somebody from this side. You guys, where are you guys from? I'm going to call on you. I can't see your name tag.
TiE, Carolina.
TiE, Carolina. What was your best part of the program?
I like seeing the electric car.
The electric car. All right. Anybody else, guys?
Boston.
You guys from Boston? What was your favorite part?
I like your fun facts.
Oh, you like my fun fact? By the way, I have lots of fun facts about San Diego. So he was in my van and he liked the fun fact. All right. How about somebody in the middle row?
Atlanta.
Atlanta. Your favorite part?
Ours was the art and design.
The what design?
The makerspace.
The makerspace. Okay, excellent. Somebody in the back.
Orange County and
You guys came a long distance. Orange County, go ahead.
touring Truvian Health.
Oh, Truvian. Yeah. What was your favorite part of Truvian?
Going through their lab and looking at how they make them.
Did you like dressing up with the glasses and the gloves and everything? Yeah. Did you get pictures with it?
No.
What? Go back. Okay, all right. All right, how about on this side? Who was on the tour? Go ahead. Sorry? Hyderabad? They really like the car? Qualcomm? What was your favorite part of Qualcomm?
I like the VR experience.
The VR experience. Very nice. All right. Anybody else want to volunteer before I call on you? How about the leads or the mentors? Can I hear from the mentors? Samir?
So today,
Actually, you don't want to should pass this on.
today, actually, the best part was a whole lot of cool conversations with a whole lot of really cool people. So, aside from Truvian and Qualcomm, all of it, that's awesome.
Awesome. Anybody else like to say a few words?
Thanks, Sandeep.
You're welcome. All right. Let me play a quick video for you and before we start our program today. Judy, go ahead.
Young entrepreneur in fostering and mentoring what needs to be done as a business, and that could be in form of capital, it could be in form of training, it could be in form.
I don't know.
What I would say about TiE is full of very interesting people. There's a lot of diversity in the interests and skills of the people that are there.
They have brought a discourse to the entrepreneurial world that doesn't appear anyplace else.
There's very sincere interest in creating an environment for innovation and inclusion and inspiration and support.
TiE is mentorship to budding entrepreneurs or someone who wants to scale their company.
TiE has always been an excellent place for me to network and also to find out what's happening in technology in the world.
TiE for me is a way for me to give back to somebody else who could use that same help.
The things that I think TiE does is that's terrific is bringing out, on a monthly basis, speakers and people that stimulate the thinking and education.
The events, the panels, the simulation that you get in terms of new ideas is important, plus the people that you're going to meet and interact with are some of the great people in town.
I like to help other entrepreneurs, budding entrepreneurs, form a company, to get funding, to launch their companies, help them with, positioning, who their customers would be, and things like that.
Every time I think that I have learned everything, some bright guy at TiE really makes me feel dumb because he knows a bunch of stuff that I don't know. Keep learning and keep getting educated. TiE is the best place to do that.
I think the other area that TiE could really scale up is in bringing investments to these budding entrepreneurs. Some of these entrepreneurs have great ideas, but they need to be connected.
much of what we've got here is bio-driven or it's component-driven. And I believe that the next phase of innovation that's going to be crucial to humanity is where technology and humanity connect, and that's at the application layer. I'm hoping that just like LA is a hotspot for entertainment and Silicon Valley is a hotspot, that San Diego can become a hotspot for the next phase of technology.
The region needs to get entrepreneurs involved in the day-to-day workings of government so that government can be more transparent, more technologically sophisticated, and provide better services to people.
And we seem to be very bashful about what we've accomplished here in San Diego. And I think we have to let the world know about that.
TiE is one of the best kept secrets that people just don't know about it, especially as a young business that may look for some mentoring or guidance or even capital. People don't know where they are and who to look for, so I am doing my best to get the word out there in the community that here's an organization that's almost 30 years old that nobody knows about.
TiE can help San Diego have an image, have a persona that is viewed as an outstanding place to not only live and raise kids, but also build strong teams and innovative products.
Artificial intelligence, genomics, and cellular wireless. This is the ground zero for that. If you're not here providing those funds, you're probably missing out on a bunch of unicorns maybe.
Okay, sorry about the sound. I'm not sure what was going on. All right. So a couple of things. Housekeeping item. Number one, everybody who's competing tomorrow, registration is at 7 a.m. And if you have your name badges, make sure you bring your name badges with you. Everything's on there. So don't forget it, as Taylor mentioned earlier. Also, how many of you going on the cruise? Raise your hand if you're going on the cruise. Okay, there was a question. We're meeting at 1800 North Harbor Drive. So some of you were asking, where are we meeting? It's 1800 North Harbor Drive. And Taylor, what time are we meeting there? 6 o'clock. What time does the boat leave?
7.
Boat leaves at 7. We're meeting at 6 o'clock, North Harbor Drive.
It comes back at 10. It's a 3-hour harbor cruise.
Okay. All right. So, yes. Pier 1. Pier 1. Okay. And again, tomorrow you can ask, but I know there were a couple of questions that had came up earlier. So, I want to thank you all for going with us today and coming here. I know there was a little bit of a hike for all of you to get here, but this is our monthly event that we do for TiE. And I'm here to introduce you to our, we have a great program. I know you guys had a long day with the different speakers, so I'm going to get the program started. Do you want to say something? Okay. So, I want to introduce Jay Bhagat. Jay Bhagat is the Vice President of San Diego, TiE San Diego. And he's not just anybody, guys. And if you want a picture with him before you leave today, Amanda, where are you?
Right here.
Amanda's right here. Jay is a very modest person. He's very down to earth, and you would never know who he is. But he is credited for what we now know as, are you ready for this? Texting. Jay gets the credit for what we use as texting today. He's an amazing person. We are very, very fortunate to have him on our chapter. So with that short introduction, would you all give a standing ovation for Jay Bhagat, please?
I learn from you every day. This guy, this gentleman, he's got such a personality, so, optimistic and so much energy. Yeah, I wish, Sandeep, I would be like you when I grow up. Okay, guys, I'm going to sit down. I have a little bit of issue with my back. First of all, where I see we got a lot of young entrepreneurs here from all over the world, I guess. I believe you had some sightseeing today. San Diego, if you have not realized, is the finest city of the U.S. So just remember it. When you start your company, you know where your home is. Come back to San Diego. San Diego is a great place for startups. A lot is going on here, very progressive. So, and you got excellent TiE charter members to help you out when you start your company. You can provide mentoring. Naresh, who is our president, he's representing TiE at the White House in connection with India's Prime Minister Modi and President Biden. I told Naresh, you don't have to go, I'll go. What a guy, he won't give me the chance. No, just kidding. He's a great guy under Naresh's leadership. Our chapter, TiE chapter San Diego, has done a fantastic job. We have, in the last 5 months, doubled our charter membership. And we are financially very sound. Go to the leadership of Varaiya and some of our executive committee members. I see my friend here, Mr. Heungsoo. He's our charter member. And his company, he and his company, they have been so grateful to us for making this fantastic, beautiful place available for every event. Thank you. And we have a special guest here today, Mr. Alex Powell. If you would stand up. Alex is the Vice President of Goldman Sachs. Thank you. Now I have a job here to introduce the moderator of our panel for the night. Someone I talk to him probably every day, but that's Nikhil. But I'll know it so well, but I'll still read your bias. I don't want to miss out anything here.
Just a few words is all we need.
Nikhil Rai, he's a professor in the finance department at the Fowler College of Business at San Diego State University. He has also served as chair of the finance department and director of graduate programs at the Fowler College of Business. His additional teaching experience has included the Cox School of Business, Southern Methodist University in Dallas, and the School of Business Administration, University of Washington State. What year were you at SMU?
82 through about 83 through 88.
Okay, so the chancellor of SMU, Gerald Turner, he was on the board of that company, but that was, I think, later on, like in the early 90s. Nikhil has served as president 2006 to 2008 of the TiE San Diego, where he is a charter member and a member of the executive committee. He is past president of San Diego chapter of Financial Executive International and currently vice president of professional development. He was chairman, board of directors of Youth Credit Union from 1996 to 1999 and member of its board from 1993 to 2000. He received his BS in mathematics and MA in economics from Bombay University. He completed his MBA and PhD as finance at the University of Washington, Seattle. With this, please welcome Nikhil.
Thank you, Jay. Can people hear me?
Yes.
So thank you, Jay, for the generous introduction. And welcome to all of you, including the to-be entrepreneurs, if they're not already entrepreneurs, from California as well as the rest of the country, and also from India and maybe other countries besides India. So today, this topic is potential exits for startups. So what I'm going to do is set sort of the stage for the panel. We have a star panel that is going to talk about various aspects of this topic, in particular about M&A. And so what we'll do is each of them will present, and after their presentations are done, the panel will be over here so that then they can answer questions. So what I wanted to do is to give you a sense of the life cycle of startups. And so what I've got over here is a graphic that you can do this sort of a mental exercise, that if I look at about 1,000 startups, so on the horizontal axis I've got time, on the vertical axis you can think of in terms of value or size. And what this graphic says is that what happens to these startups over the roughly next 15 years. So the green line tells you that about 65% of these startups will vanish in 5 years. The red line tells you that roughly 25% of the cohort of startups will remain private companies, will never go public. So if I add up the red and the green, that's almost 90%. Then we have the blue line that I've sort of labeled gazelles. These are the 5 to 10% of the startups that have very rapid growth. These are the ones that you often hear about. These are the ones that garner a lot of press. And these are the ones that probably attract angel or VC capital. That's the blue line. Of that group, about 10 to 30% of them, or about 20% of them, will have IPOs or initial public offerings. So of the initial cohort, that's about 1 to 3% of the startups that will have IPOs. And what is amazing is that even after they've had IPOs, as you know, IPO is sort of the mark or the, in some sense, indication that these companies have enormous growth prospects. These are the ones that have been vetted by analysts, by investment bankers, and so on. What happens is even after IPO, about 20% of these companies are going to go under. That's the sort of gray line. And then we have about 30% of them that post-IPO will not have a lot of growth, either because the market changed on them, they had some issues in how they were managing. And these are companies that sort of don't attract a lot of analyst attention after they've gone public. These are typically considered small cap companies. And then finally, you see the purple bar. These are companies that continue to grow. These are what we call long-lived public corporations. That's about 1 to 2% of the initial group of 1,000. Incidentally, all of the data is based on US startups. This data goes back almost 45, 50 years, and this data is very, very robust. So what happens is that if you look at the evolution of startups, the bottom line is that 1 to 2% of startups will become large public companies. These are the ones that are your today's Teslas, Qualcomms, Walmarts, and so on. So that's something to sort of keep in mind. Here is data from a very famous study done at Duke University that tells you what happens to these startups. So what I've done is in this, I've divided the group into startups that were funded by VCs and those that were not funded by VCs. And what the data tells you is that if I look at this cohort of companies that were born between 1981 and 2005, these are startups that began there, and you follow that 10-year history, what tends to happen? What you find is that for the VC-funded group, 32% will fail by 10 years, by the 10th year. About 24% will get acquired over a 10-year period. And about 8% of them will have IPOs. So this is sort of the resolution of what happens to these startups over time. If you look at the non-VC funded group, about 62% will go under or will fail by 10 years. Just about 1% of these companies will get acquired. And 1/10 of 1% will have IPOs. So what this is, first of all, telling us is there's something that VCs do that is quite different from non-VCs. So what you find is that VCs funded startups have lower failure rates, higher acquisition rates, and higher IPO rates compared to this group over here. This is a slide of US public companies, the number of US public companies across all exchanges in the United States. What this thing tells us is that somewhere around 2000 or so, we had a peak of about 8,000 public companies, so 7,500 public companies. Today, they are down to about 4,500. So being a public company is a very unlikely event based on the data that we have for the United States. At the bottom, I've shown you the number of IPOs over a certain length of time. So this is data from 1990 to about 2022. 1999, there was an average of about 368 IPOs. This, if you remember, was the dot-com boom. Lots of IPOs, and people were saying that if it was a company called crap.com, people would buy this stuff. Okay? Today they're saying this is what we are seeing with respect to AI and so on. Then we had the IPO bust from 2000 to 2009. The average number of IPOs dropped to about 127. And 2010 to 2020, there's been not much change, about 115. Over this entire period, it's about 200. On average, in any given year, there are about 200 IPOs. And one last slide. So what I've done is I've taken data from what's called the Bureau of Labor Statistics. They provide what are called business dynamic statistics. And what I've done is I've taken the data and broken up into 3 groups. Employer firm is a firm that has at least 1 employee. At least 2 employees, excuse me. Less than 20 employees, between 20 to 499, and bigger than 500. Most public companies are probably going to do it. So what it's telling us is something that's quite interesting. Incidentally, this data goes back. I've looked at this data over decades. Percentages are very much similar. There are about 20,000 companies with more than 500 employees. That's 0.35% of all employer firms that employ 71 million people. Between 20 and 499, there were about 620,000 firms, 11.6% of the total number of employer firms that employed 30.1% of the labor force. And then we have less than 20 employees, which is 88% of all companies, that employed 22 million people. That is about 16.5% of the workforce. Look at the average firm size in each group. It's about 5 employees, about 65, and about 3,500. So the message over here is the following. In a dynamic economy like ours, we want lots of startups. But we want startups to become large companies. So you want all sorts of startups, and all of you want to create the next Tesla, the next Qualcomm. Because remember, all of these companies were startups at one point. Because what this thing is telling us is that are not there. The remaining 99% of the companies have to create 71 million jobs. So our panel is going to talk about what happens to these startups as they are growing. And what I'm going to do is just quickly introduce the panel, and then we'll have them, each of them come over here. Incidentally, we're going to keep the Q&A to the end so that there's enough time for everybody.
Professor Varaiya, what are the chances of all these companies, what do they have in common that took them public, that you can inspire these young kids? What would you say that got them there?
Oh, what got them there were people like Irvin Jacobs, people like Musk, and all of those others who mentored them. Okay, that's the important part about this. So this is a journey that you have to sort of keep in mind. The goal is, incidentally, I just sort of mentioned that if you don't go public, that's not a bad thing. There are about 25% of companies that will never go public, that will remain private. Some of them will be spectacularly large, but these are companies that are doing very, very well. That's something to sort of keep in mind, because we are all conditioned to think that I want to be the next Tesla or the next Qualcomm, and so on. Not everybody, as the data shows, is going to be in that. So as I quickly introduce the panel, I think, Tyler, you're going to go first?
Yeah.
So Tyler Lay is a VP of Finance at JP Morgan, and he provides corporate finance advice to larger and medium cap companies in film, TV, and the music space. So, Tyler.
Okay, well.
Press the key.
Okay, there we go. Well, hello everyone. So, thank you for having me. Give you a little bit of background about myself, as I think the bio that was pulled on me is a little stale. The film and TV world that I used to operate in was former life. Did a lot of leverage finance work for large content production companies up in LA, video game companies, and music companies up there. But about 2 years ago, I moved down here to San Diego to focus on the innovation economy and the startup ecosystem down here in San Diego, and had the opportunity to kind of build out the team down here. Now I head up our technology and disruptive commerce team here in San Diego. Our team focuses on companies in the technology space and high growth consumer type companies as well. Most of our clients are high growth and backed by venture capital or other institutional dollars. So we spend a lot of time working with companies that ideally might be companies that you are working on right now, that are anywhere from their seed stage up to Series D, E, whatever it is, looking for an exit. And we kind of cover everything in between. So we see things at the very beginning, where they're companies opening up their first checking account, all the way up to companies that are doing pre-IPO planning, and we have about 5 or 6 of those companies here in San Diego that are working through some pre-IPO prep. As soon as the markets open up, they're going to look to chat with us. So really what my initial conversation is with you all is to kind of give a sense of kind of what the broader macroeconomic environment is that a lot of these startups are facing, and how it really interacts and a lot of times dictates their potential exits, be it the public markets or through the private markets via M&A activity. So really this slide here is just to kind of put into context where we're really at in the economic environment right now. As I think a lot of you have probably seen, recently we had Silicon Valley Bank kind of collapse and implode a few months ago, as well as a couple other banks. And to put that in context, those 3 banks that failed earlier this year, if we're going by total asset size, the total assets of those banks are greater than the total assets of all the banks that failed during the 2008 crisis. And so really on this slide here, we try to kind of distill, or at least our research team try to distill a lot of the really complex factors that make up the broader economy and put together a aggregate economic conditions index, which is a fancy way of saying just how bad is the current state of the economy, or how great is it in this current environment relative to data that we have over the past 25 years. So if you look at the far left here, October 2008, right after the great financial crisis, based off of all these metrics here that kind of make up this index, we were at 18%, which is not great. And as you can see, like right after COVID, things like that, when we were flushing the economy full with tons of capital, just printing money left and right, we got up to a 76, which was very close to 25-year max, 77%. And jumping over to today in our current environment, we're right about 48% based off of all the data that we've kind of put into it. So not great, also not terrible, especially given the size and scale of the actual banking crisis that we recently went through. And some of the drivers here, I'm not going to go into a lot of them, but U.S. unemployment, based off of kind of the official numbers and figures, 3.44%. It's pretty good relative to what we've seen over the past 25 years, and that's I think dragging the index up maybe artificially inflating it a little bit. But then on the other end of the spectrum here, CPI, Consumer Price Index, inflation, 4.9%, obviously down in the lower quartile here. That's something that's been on the higher end of the spectrum of what we've seen, and frankly makes a lot of sense that we're seeing inflation at that level, just kind of given all of the capital that we've been injecting into the economy. So that's kind of setting the stage to give you a sense of where we are in the macro environment right now. I think there's still a lot of questions as to where the economy goes, how it shakes out, especially with the Fed raising rates as quickly as they've been raising them, and the impact that that has on firms' access to capital, be it equity capital or debt capital if you're looking to get some debt financing for your business. And those things tend to have a drag effect in terms of their impact to the economy. And so looking at things in a little bit more detail, inflation, as I kind of touched on, that's been the main thing. If you hear about the economy, everyone's talking about inflation, how high it is. And the Federal Reserve has been doing its hardest to try to reverse inflation with its rapid rate hikes. And those rate hikes have been kind of strangling the economy to a certain extent. So this is just kind of our thoughts on inflation and kind of where we see it going over the next few quarters and next year or so. And that kind of directly ties into this next bullet here on the economic growth that we're seeing and how we think it's going to slow over the next few years as the impacts of those raising the rates trickle through to the rest of the economy, and we start to see really the impacts of that and it start to slow down. And you're really actually already seeing the impacts of that in kind of the startup world that I operate in and my clients operate in, where they are having challenges with access to capital, or they are looking at different exit opportunities and having to kind of reevaluate kind of what they've been thinking on that front. Let's see here. Well, the third bullet here, should probably touch on this, definitely ties into the overall economy. Just the consumer. We're seeing the consumer get strangled more and more. And for those of you that are focusing on maybe retail-focused businesses or consumer-focused businesses, definitely something to keep in mind is the overall health of the consumer and all the challenges that they're currently facing. The consumer was doing great a year or so ago. They had a bunch of savings saved up from not really going out and having to stay home during COVID, and they're quickly depleting those savings, given the rise in inflation that we've seen and cost of goods becoming more and more expensive. Everything from eggs to auto payments to everything else is getting more and more expensive. And that's starting to really put a damper on the consumer, and as I'm sure a lot of you know, the consumer drives a good part of our economy. And the last one, job creation. Like I showed on the last slide, unemployment's still relatively low, but depending what happens in the economy over the next couple months, we could see a rise in unemployment if we go into more of a hard landing on the economy with the rising rate environment and as those rates kind of trickle through. So a lot is still kind of to be determined on the economy, but we're definitely starting to feel some of the impacts of it already. And we have an idea of how some of those economic factors could kind of impact some things going forward. So really to get to kind of what most of the panelists here to talk today about is M&A and how the economy is really impacting the M&A themes that we're seeing. Now, a lot of these themes are for larger scale companies, right? And I'll talk about some of the effects that it's having on more of the startup companies and entrepreneur, founder-focused businesses that I'm having conversations with my clients about kind of today and on a daily basis. So the good news about kind of what's going on in the broader economy is the public markets and exits through the public markets have drastically slowed. Really, there was one test of the public markets last week. It was a food chain called Kava. Have any of y'all had Kava? Mm-hmm. It's delicious. I love it. They IPO'd last Thursday. It was actually something that JP Morgan was involved with. And that IPO was looked at as kind of a signal to the rest of the startup or venture capital backed unicorns and all those that have been waiting to see what the market is going to do, how it's going to react, because it's kind of been frozen. There hasn't been a lot of public markets activity. The Kava IPO debuted very well, at least on the initial day, and was up quite a bit, so maybe we didn't do as good of a job pricing it as we should have, but it was a successful IPO. And so now the question is being asked, are the IPO markets back open? Is this a viable exit strategy now for a lot of the startups that we've been working with? Should they start to look at the public markets and see what's going on and maybe look to tap those markets as their exit here at some point this year? I think that's probably still TBD, and in my personal opinion, it's still probably not the best time to be going out to the public markets. I think it probably behooves folks to wait a little bit longer before they test those markets. There might be a small window here, but depending how the economy goes, if rates stay at this level, the market's probably going to close again here very shortly over the rest of this year and probably a decent part of 2024 as well before it's really a viable option for folks. The challenge is, though, that a lot of these companies have institutional capital behind them, and that institutional capital is pushing these companies to make some sort of an exit. The original plan may have been IPO, but now given the market dynamics, they have to shift to maybe potentially an M&A strategy or maybe raising some additional capital until the IPO markets open up again. Good news is on the M&A front, there's still a lot of good conversations going on there. A lot of it's being driven by large corporates and looking to make strategic acquisitions. And they feel that at this point in time, there's a potential opportunity to make an acquisition at a price level or a valuation that's slightly depressed from what it was a few years ago. I think there's a little bit of a disconnect in the market, though, where founders and entrepreneurs are still looking at the valuations of their companies at the levels that they were when they got their last financing round, which was probably around 2021, 2022. When we were still at elevated levels, but now the market has come down. So there needs to be some sort of a convergence, and those two ends of the spectrum need to meet for the market to really fully stabilize. So it's kind of a little bit of a battle right now of startups looking to hold out and wait it out until they get valuations back up to a level that they were comfortable with. And then you also have investors pushing them to, sell the business or IPO. there's a few dynamics going on, and they will continue to fight each other until we get to some sort of an equilibrium. So really the biggest driver that we're kind of seeing of things here is the tactical and the strategic M&A until those public markets open up again. And a lot of startups, especially the ones down here that we're having conversations with, they're really struggling between, okay, do I look to go out and raise an additional round of capital to keep my business going and to keep it growing, and try to wait out the storm, if you will, before I prepare for an IPO or some sort of other exit, or do I look to sell the business now? So those are a lot of the questions and a lot of the dialogue that we're having with folks. And a lot of them are having trouble finding capital if they look to kind of extend that runway. So to kind of wrap it all up here a little bit and let the other folks get on here. Basically, we're at a very interesting time where the dynamics in the market have changed drastically from what they were a year or two ago. Money is no longer free, cheap, easily accessible. It's expensive, and folks are being rather stingy with it. And the startups and entrepreneurs also have a sky-high version of their valuation, and that has not come down to reality yet. So we're seeing folks with good businesses still have access to capital. If you have a strong business and a strong business plan and a path to profitability, you're in a pretty good spot, and you can probably raise some capital or sell your business easily. It's the folks that don't quite have things really dialed in just yet, or aren't quite there, and maybe need a little bit more time to get there, but they also need a little bit more money. Those folks are facing some challenges on not only finding capital, but also selling their business. So with that, I will kind of wrap it up. Appreciate the time, everyone, and look forward to the Q&A session later.
Flashing red, Heungsoo. So flashing red.
Oh. Did I break it?
I think that's okay.
That's good.
Our next speaker is Amy Wall. Amy is a senior VP M&A at Generation Equity, and she's a 20-year veteran in the M&A industry. She has facilitated over 600 deals at Generation Equity. So I'll have Amy say a few words about it.
Thank you so much for having me.
Let me get your presentation.
I'm very humbled by all the people in the room. There's so much talent in here. I don't know how the world is going to cope with all of this talent. So I would like to ask, how many people here own a business? Okay, we've got some business owners. Can you hear me okay? You can, okay, excellent. Okay. No, perfect.
Hold the mic a little closer.
Okay. Thank you so much, and great presentation, Tyler. I'm Amy Wall from Generational Equity. I did not have a hand in all 600 deals, just to be clear. That being said, we closed last year 172 deals, and the year before we closed 172, which was a record year. This year we're on target to close, I think we're at like 60 deals, so we're on target to have another record year. As Tyler said, there's still lots of opportunity, and we'll get to that in a minute. Before we do that, I wanted to introduce myself and kind of tell you a little bit about me. I started in the industry in 1997. It's probably a year that some of you were born in the room. Maybe even before that. So about 2 years in, I left for a small stint and opened up a chain of supermarkets in Australia. And I had my first daughter, and when she was about 5 months old, we sold the businesses and we moved to New Zealand. And we were there for 10 years. I had a second daughter there. And while I was there, I got a call from someone from Generational Equity saying, can you help us out? Because I'm known in the industry for being a matchmaker. So I said, absolutely. When my kids were sleeping, I would do some work on the side. I contracted while I was in New Zealand for many years, and then when we moved back to the States, they offered me a job as a senior VP, and so that's how I am. That's how I am here today. Before we get started on the presentation, I wanted to tell a joke. Why did the individual buy a bakery? Because he needed the dough. Now, if you think that joke was bad, I asked ChatGPT to write me a joke tonight, and the jokes that it produced were so bad. It made dad jokes look funny, so. Okay, so matchmaking. So okay, we're going to talk about, let me think about this for a second. So I know some people in the room are just getting started with their careers, and some people own businesses. And I think it's really important when you are involved in business to understand exit strategies, whether you're starting or you're in the middle of it or you're at retirement. Now, most of our clients are retiring, so we mostly deal with people at the very end of their career, but ultimately when it comes to a business, you're going to exit one way or the other, whether you get carried out or whether you choose your own exit strategy. So knowing when you're first starting out what buyers are looking for is really important. So buyers, now every M&A transaction is completely different. Every company is different, every need of the buyer is different, every need of the seller is different. So this is a generally speaking, what buyers are looking for. Buyers are looking for synergies. So if you own a door manufacturing company and you have to buy the door handles, if you acquire a door handle company, you would get the revenue from the door handle company, but you would also then not have to pay for the door handles on your door. So that is a scenario in business where 1 + 1 = 3. And that's, buyers are often looking for synergistic fits, so they're looking for reasons to acquire a company that would not only give them the revenue, but give them an additional benefit. Buyers are also looking for profitability. This is pretty straightforward. They're looking often for inorganic growth, so that just to take on the customers and so forth, or maybe to expand geographically, or to gain market share. Buyers are also looking, obviously, for growth potential, and this is something that was mentioned earlier on. With a company, if you've already reached your potential, you don't really have anything for a buyer. A buyer wants to know that they can come in and grow the company further, right? Otherwise, they just put their money in the bank. So you always want to sell your company when you're on an upswing, not when you're at the very top, at the peak. But that really isn't a company that you have to sell. Now, that being said, it's not unusual for a buyer to come in and breathe new life into a company, so you do get that as well. One of the things that we deal with in M&A are owners who are very integral to the business. They're the brains of the business. They work 20 hours a day and don't get any sleep at night. And they run everything. They're in charge of everything. They have their hands in everything. That kind of business is really hard to sell because a buyer would come in and they would have to. They couldn't replicate what the owner is doing, and it puts them at risk when the owner then leaves. Then they have to figure out how to make all of it work. So buyers like businesses that have strong management teams that run on their own without the owner constantly having to be there. And this is something for the younger people in the room who are on the other side of it to keep in mind, that as you're running your company, you want to slowly learn how to let go. Slowly learn how to let go aspects of your business so that you can step away, because that makes your company far more valuable for a buyer. Companies are looking for loyal employees. This is extremely important. Employment is really tough right now. And in certain industries, like in technology and in restaurants, it's very hard to find workers. And so a buyer coming in wants to see a business that has a strong employment history with very loyal employees and people who are going to stick around even after the owner leaves. This is a very important one, low customer concentration. We had a problem with a client recently who had, they lost a major customer. And when they lost that customer, they lost 3/4 of their revenue. They ended up going from $250,000 in profit to $50,000 in profit. And so, we see this often, and then their business is worth hardly anything. So it's very important, again, to the young people in the room, when you start your business, you want to make sure that you don't have one main customer. Like Qualcomm is my only customer. Well, if something happens with that contract, you don't have a business. So it's very important. A new customer, a new client, a new contract is worth far more than the existing contract. Even if the dollar for dollar amount is the same, it's worth more because ultimately it makes your company worth more money. Private equity groups, we'll talk about those later. I'll cover the platform and add-on acquisitions a little bit later. So what are sellers looking for? Well, I think some of you in the room could probably answer this just as well as me. But in terms of generally speaking, what we see our clients, what they're looking for, sellers are looking for chemistry. It's really important when a buyer and seller meet that there's a chemistry and that they like each other. Because they have to, A, deal with each other through due diligence. B, sometimes people want to stick around for a while, so you want to make sure that there's chemistry so that if you're working with someone or having to work for someone, that you really like them. Chemistry also ties into the next point of the employees being taken care of. A lot of times our sellers, they've had the same employees for 30 years, and they want to make sure that when they sell their company, that those employees are taken care of. Let's see, sellers. Yeah, a lot of these companies have been, started from and run for 20, 30, 40 years, and they're known in the community. They have a reputation, and sellers want to make sure that that legacy is carried on, and that the name of their company, who is linked to them as the person who started it, the good reputation continues. Sellers are, a lot of people think, sellers are looking for money. Money is actually one of the less desired part of a deal, because if someone wants to make money, they just keep running their business. Your business is profitable. You don't usually sell your business to make money. If there was no money to be made in the business, you wouldn't have a buyer. So money is usually not the number one motivation for people to sell their business. And sellers are often looking for specific deal structures, whether it's quick exit, cash, take the cash, do a short transition period and go. Whether it's an earn-out, so maybe staying for 2 or 3 years and watching the company grow and earning some money from it, or partial ownership, maintaining some of the ownership. We have a client right now that we're working with who they really love what they do, but they don't like the everyday management part of their job, their CEO part of the job. So they're looking to have a CEO come in so that they can continue with the job, continue doing what they love, and having someone else do the business side of it. So they will likely take a structure that gives them partial ownership. So finding a match between a buyer and a seller, it's quite complicated. Again, there's a lot of factors involved. What we use when we talk about strategic buyers, they're not all technically strategic buyers, but we use it as a catch-all term for companies. So finding a company to acquire another company, a privately owned company. The most likely targets are acquisitive companies, which are companies who bought a business, companies who are searching the internet for acquisition opportunities. The technology these days is amazing that we're able to find that. so I know that I was talking to Tyler in the beginning before we presented, and he has a Rolodex of people that he knows are looking for companies. We are the same. We have, for every deal, we have several NDAs that were signed. So we can use that as a way to find companies who are looking for acquisitions. We usually also go to a general company search and we look for companies who we know it would be a good strategic fit.
Amy, we need a good story of a good match that you were involved with.
Okay, I'll give you a story. A good match. Okay. Let's see. So I would say the best match, I had a company in November, last November that sold in the new year. And the company was, they did ultra high-end, fine architectural millwork. And the company was fantastic. The artwork that they did in these homes was incredible. And we matched them with a company that is run by the employees of the company in ESOP. And it was a fantastic, we love those buyers because, first of all, besides the fact that ESOPs are required to take the highest offer, so they tend to have higher bids for the company, but also the owner knew that all their employees were going to be taken care of because the ESOP was coming in to buy the company and turn that also into an ESOP. So that was probably one of my favorite.
How big was the company?
17 million. I'll get through this really quick. Okay, so lastly, just talking very quickly about private equity groups buying up middle market privately owned companies. We had private equity groups do two types of acquisitions. They do platform acquisitions and they do add-on acquisitions. Platform acquisitions are like when a private equity group or an investor wants to invest in an industry. So let's say when we met with private equity groups in May, they were telling us they're interested in ed tech, educational technology. So they would be looking for a platform investment. So the companies have to be quite large. They need profits between 3 and 4 million, 3 and 5 million minimum in EBITDA. So for what I do, I tend to sell smaller companies. We tend to be more of an add-on shop for private equity groups. So if a private equity group already has a holding in a space, they might look for acquisitions to add on to it, to bolt on. So those acquisitions are usually what we get involved with. I would say about half of our companies are, about half are from private equity groups, half are from strategics, and a small percentage are from individual, high net worth individuals. So yeah, speaking of high net worth individuals, usually they're executives in companies who want to run a similar business. They want to run it on their own, or individuals maybe wanting to buy a job. So anyway, that's me. Looking forward to any questions at the end. Yeah?
Yeah, one question I have is, when it comes to evaluating these smaller companies, what approach do you typically use? Is it discounted cash flow, multiples, comparables? How do you value companies?
Okay, that's a good question. So his question was, how do we value companies? Do we use discounted cash flow or a multiple of EBIT? We value a company in several approaches. We look at comps, we do discounted cash flow, and we look at multiples of EBITDA. Because we've sold so many companies over the years, we have tons of data, and we really depend on that because it's real-world data. In my world, I'm a deal maker, so I'm boots on the ground. We see mostly multiples of EBITDA. Most companies aren't using discounted cash flow, and I would say most companies that are not in technology and healthcare go for about 3 to 4 times EBITDA. During times where things were really good, last year and the year before, we were seeing multiples in the 6 range. And of course, in technology and healthcare, we usually expect something higher, sometimes up to 10 times EBITDA.
And is it only you who's doing the valuation, or do the buyers and sellers have their own?
So the way our process works at Generational, we don't market our companies with a price. We let buyers come to the table with their best offer. So we have a team that does evaluation, but the evaluation that we provide is for sellers so that they can recognize what a good deal is. So, if we tell you your company's worth $3 million, if you get an offer for $6 million, you know it's really good. Most entrepreneurs think their business is worth far more than it is. We spend a lot of time managing expectations. And so it's really important. The valuation that we do is very important to help manage expectations, and we usually get it pretty right.
I have one question. So generally, thank you so much.
Can we hold off the questions because we'd like to have all the presentations done? Okay, thank you. And some of these questions will be addressed in what Akash is also talking about. Let me introduce Akash Chilka. He is managing partner at Capital Insights. And Akash has been in this business for over 15 years and handles all aspects of the deal-making process at Capital Insights. I'll talk a little bit about what he actually does.
Thank you, Professor, for the kind words. So a couple of corrections where I have not been in the industry for 15 years. I've been in the industry for about 8 years or so. And I'm not a managing partner, I'm a managing director of the firm. So my background is primarily within the multi-unit franchise space. All I do is gas stations, convenience stores, and restaurants. Something that Tyler briefly talked about, Kawa, that went public, we were tracking that way as well. So I've put together a small presentation, not really knowing what the audience composition is going to be. It seems like there are a lot of young folks in the audience today. So it's probably, it would be helpful if I were to go through the granularities of the M&A process, including what a process would entail, and then get into the structures and how do you structure a certain transaction. Probably also talk about valuations and stuff like that. So when it comes to running an M&A process, the very first step is the planning and strategy development, where we work with owners, founders, companies to figure out what their end goal is, try to figure out what are they trying to accomplish, if the goal is to grow or if it is to exit. That takes the most amount of time. Figuring out what the valuation would be. Again, layering into what Amy just talked about in terms of valuation and addressing the gentleman back there. The sellers generally do value their company. They have a price in mind. However, within a process, you generally do not put out a price. It's up to the buyer to basically value the company. You furnish all of the information and it's ultimately up to them to basically come up with the price. So within the planning and strategy development, that is what you work with the owners to figure out what exactly are they trying to accomplish. The next step is preparation and analysis, which entails putting together a confidential marketing memorandum, putting together a financial model, figuring out what additional items are required, and they're very specific to the trade that you're working on. And the very final step is execution. Execution entails reaching out to potential buyers, which also takes into consideration what Amy does. It's a very important part of the process. If it's the most important part of the process, you are basically trying to reach out to a targeted group of buyers and investors who are looking to buy companies that you're trying to sell. So that's the most important part of the process. Now, a deal can be structured in several ways. There can be a merger, it can be an acquisition, it can be a joint venture, it can be a licensing agreement, it can be a royalty agreement, and ultimately an IPO. What we have seen this year, especially within the restaurant industry, is a dearth of companies going public, taking specifically Kava. From what I remember, it opened at about $17 a share. That was about 6 times revenue, and the only comparable within that industry that sort of really is a real comp to Kava within the fast casual restaurant space is Chipotle, and Chipotle, being a mature company, was also trading at about 6 times revenue. So in terms of the pricing, our understanding was that it was priced right. However, since there was just so much, because of the dearth of good deals in the market, you saw the price running up, especially when it opened. Now, valuation considerations. So when you're trying to value a company, it's not just about running a DCF. It's not just about running, looking through public comps or existing transactions and what has occurred in the past. It's more than that. You have to figure out what if there are synergies, right? If, for example, there are 2 set of buyers, primarily, I'm talking from the perspective of multi-unit franchise, a financial buyer and a strategic buyer. Generally, a financial buyer is looking for a certain rate of return on the investment. However, when it comes to a strategic buyer, they're looking for a platform investment. So a strategic buyer is bound to pay slightly more than a financial buyer would, primarily because there are a lot of synergies, especially when it comes to back office. G&A, for example. Within the restaurant world, G&A forms about 5% of your P&L. So if you were to acquire another platform, for example, company A that is within the fast casual segment buys another company B, also within the same segment, but a different market, they can basically shrink the G&A just by acquiring the other company, which also plays into the overall valuation where they are able to pay a little more. So this is the slide that I would want to spend a little more time on, and it is primarily about structuring a trade. Within M&A, you can either structure it as an asset sale or a stock sale. Now, again, this list is not exhaustive. This is based on my understanding of what differentiates the two. I've identified 12 factors. Of the 12, 5 primary factors that I would like to cover are, when it comes to an asset trade, obviously a buyer can pick and choose what liabilities they would want to assume. And then the seller is stuck with the remainder of them. Again, talking from the restaurant perspective, a potential buyer generally always assumes leases for restaurants. But they would sometimes not want to assume other liabilities, including gift cards and so on and so forth. That sort of plays well for the acquirer, but not for the seller, because there are several laws associated with gift cards, and they're very state specific. They're called as treatment laws. So that's one possible con for an asset acquisition. However, asset versus stock, an asset trade is slightly more easier to execute, primarily because of the time that it requires. Especially when it comes to industries that I focus on primarily, which are asset heavy versus asset light. When a good component of your balance sheet is made up of fixed assets, it makes it so much easier to structure a transaction in the form of an asset purchase versus a stock purchase. And then, obviously, the most important aspect is the valuation. And valuation it's not that simple to understand what would work for an owner, founder. An asset versus stock trade, again, can have its own benefits and have its own cons, but when it comes to the ultimate proceeds to the shareholders or the members of a particular organization, you have to take into consideration the tax implications. One possible benefit of structuring an asset trade is the stepper basis. A stepper basis is essentially gives the buyer, the flexibility to basically allocate purchase price between tangibles and intangible assets. That sort of also plays into what the ultimate proceeds to the shareholders would be. And then the most time-consuming, of course, are the contracts and agreements. Now, within an asset trade, of course, when you structure an asset trade, you can basically assume certain contracts, but then you have to go to your vendors, you have to go to your landlords to gain approval, which is a time-consuming process. However, with a stock trade, it's assumed, it's automatic. So in short, asset versus stock, it depends on the industry that you're in, and it's not very straightforward. Talking a little bit more about the consideration within an asset versus stock trade, it can either be cash or stock. Cash versus stock has its own merits. And it all depends on the stage of the company. If a certain company is at its, it's a mature organization, it has achieved what it has to achieve. Their goal would be to get out of that system, get cash, get out of it, exit completely. However, if they are a growing organization, they would want to roll in some of their equity and probably get a second bite at the apple. Again, it obviously has its own risks. A cash transaction is probably less riskier, way more. It's easy to execute versus a stock transaction. A stock transaction. Execution and negotiation within M&A. So typically, when you're running a process, there are several documents that you have to work through. The very first step within a process includes reaching out to buyers and then getting an NDA signed. Once you have your NDA signed, they typically put together an IOI, LOI, which then moves into the stage where you're trying to draft up definitive agreements. This is a very high-level overview of the kind of agreements that we generally negotiate. Your due diligence process runs concurrently with your purchase agreement and negotiation of all the ancillary documents. I think that's it from my end. Thank you so much.
Now we have Heungsoo Choi. Heungsoo is the very quickly, as Jay mentioned, Heungsoo is a partner with Knobbe Martens. Knobbe is one of the leading IP law firms. And Heungsoo will talk about all of the legal ramifications in acquisitions as well as in exit options, especially for tech businesses where IP becomes sort of very, very critical. So, thank you.
Good evening, everyone. Thank you for coming to our law firm. We are proud sponsor of TiE. We have been sponsoring TiE for the past 10 years, and we will continue to do so. We are very excited about hosting another great event today. So I am going to talk about IP side of M&A. So where does this IP fit in this big picture of M&A? I know that Amy mentioned she can find a good match between buyer and seller. So once she found buyer and seller, typically each side hires a corporate lawyer for corporate due diligence and an IP lawyer for IP due diligence to make sure that there are any hidden issues that can block the deal. So why does IP matter in M&A in the first place? To answer that question, I would like to briefly go over IP. So there are 4 types of IP: patent, trademark, copyright, and trade secret. The fundamental value of the IP is to exclude others from practicing your IP. So then why is IP important to M&A? Because right to exclude can be quite important to the deal. So if you can have a barrier to your business, so that can be very advantageous of your competitors. And also, I know that Akash mentioned valuation. Company valuation can also depend on the quality of IP. And especially in certain industries where, for example, biotech, medical device, consumer electronics, where there are some frequent litigations, you want to have offensive and defensive IP portfolio. Otherwise, your option can be very limited. So the main purpose of diligence is to identify any known issues before the deal closed, and then validate investment for the deal, and also to avoid or potentially minimize litigation between buyers and sellers. So I saw Amy talked about what buyers looking for in the business side. I'm talking about IP side. So ownership, quality, and right to practice. Let me take an easy example, easy real life example. Let's say you're a home buyer and you want to buy a house. And first of all, would you want to know if the seller actually owns the house, right? And also you want to know the condition of the house to make a good, reasonable offer. And because IP is also an asset, the property, although it's an intangible property, so there are some similarities between real property and intellectual property. But right to practice is different. So if you own a house, you can do whatever you want with your house. But IP is not working that way. I'll talk about it in a minute. So these are main issues: ownership, validity regarding whether your IP is valid, and then enforceability regarding whether your IP can be asserted against others, and whether your IP has a good scope, and whether the seller sued or threatened others, and the right to practice, whether there is any third-party IP risk, whether seller was sued by others, things like that. Encumbrances like lien, and warranties and indemnifications. Indemnifications means when a buyer is sued in the future, and seller is required to compensate for that procedure. So how can sellers better prepare? So obviously you can build a good IP portfolio in advance so that your company valuation can be higher based on your quality of IP, and then you can do your own diligence to find any hidden issues and potentially fix that if possible before the due diligence. And then typically buyers will request lots of information that we talked about: ownership, enforcement, scope, and litigation. So it will take a lot of time to put together. So you can start early on so that your transaction can be faster and can go smoother. Oh, sorry. So in terms of the ownership, you want to have ownership document in writing. So for example, IP creators, like employees, third parties, independent contractors, you want to have them sign IP ownership agreement to the company, so that you can own their IP. And then also you want to record those assignments in government, like U.S. Patent Office. And if there are multiple owners, you want to have a clean chain of title from the creators to the company. So in terms of validity, basically issued patent is presumed to be valid, but it doesn't mean that your IP is guaranteed to be valid, because it can be challenged. For example, when you sue some company, most likely that company will file an IPR called invalidity proceeding in the U.S. Patent Office, arguing that your IP is invalid over newly found prior references. And then once patent is granted, you are required to pay multiple maintenance fees, 3.5 years, 7.5 years, 11.5 years from patent grant. If not, your IP can expire. And trademark usually can be renewed indefinitely, but there is a requirement of continued use. So if you are not using your trademark for a period of time, your trademark can be subject to cancellation. And trade secret, valuable information kept secret, but you wanna make a reasonable effort to maintain that trade secret really secret. For example, using confidential stamp, you can place really important information in a safe and limiting access, things like that. So even if this is a very important issue, so whenever you sue someone, the other side will almost always raise this issue. Even if the patent is valid, your patent may not be enforceable because of your bad behavior in the past. For example, we have applicant patent owner has a duty to candor. We have to be honest with the patent office in obtaining the patent. And if you lie or if you misrepresent some material information, your patent, even if it's valid, may not be enforceable. Also, you have a duty to disclose important information such as prior information, conventional technology, that's relevant to your patent. You have to disclose to the patent office. If not, again, your patent may not be enforceable. And inventorship is also important. You have to list correct inventors. If you list more or less inventors, again, the other side can argue that your patent may be unenforceable if there is deceptive intent to deceive U.S. Patent Office. But luckily, inventorship issue can be easily corrected most of the situation. So a lot of people think patent scope is broad. I mean, the fact that patent scope is broad can be a good thing, but not always. If your scope is too broad, then it's vulnerable to invalidity challenge. But if your scope is too narrow, then you cannot go after a lot of competitors' product. So you want to have a good, maybe intermediate scope, and also you want to have the ability to modify claims to cover a competitor's product in case they do design around after your patent issue. That's why we want to have one application, continuous application pending. And if foreign market is important, you are also want to check how good the foreign IP is. And also, as I mentioned, patents will expire in 20 years from filing. So if most of the patents will expire in a year, then UIP may not be that valuable. So in IP due diligence, we also check whether seller was engaged in litigation, sued other parties or threatened other parties, because that can be really expensive. So as I said, patent gives the right to exclude others, but does not give you right to practice. So it's different from housing situation. So there may be a third-party IP that can cover your product. So to find out this kind of thing, we do landscape search. We used to call freedom to operate analysis, but our IP insurance company doesn't like that term because there is no 100% freedom to operate in this kind of scenario. So we also want to know whether there is any encumbrances, like the liens, on the IP by a bank, and also licensing situation, license either exclusive or non-exclusive, so only in this geographic area, only 3 years, that kind of thing, whether that kind of scope makes sense for your business. And then whether license is transferable, and then that kind of situation. Also, joint ownership can be very tricky. Under US patent law, each owner can practice, can commercialize without the consent of the other owner. And also, in a litigation, every owner needs to join. So this can be quite be an issue in IP due diligence. And also, software company, if you want to develop your own software using open source software, and in that situation, you want to be careful because you may be required to disclose your source code, and also may need to grant license to others in the same term that you got from the open source software in the first place. And also, if you are a seller who collect personal information, there's some requirement like annual revenue 25 million and 50% of your revenue comes from using personal information and things like that. So you have to comply with data privacy law. Otherwise, can be an issue. So obviously, warranties, indemnifications, buyers want very more warranty and indemnification, whereas sellers want to limit the liabilities. So they typically use insurance, escrow. This is very, very heavily negotiating area. I think you wanna consider, you wanna prioritize. Which one is more important to you? For example, going back to housing scenario, if you are buyer, if you demand fix minor issue in house, let's say side gate door, and what if seller refuses to do that? Do you want to just walk away? Probably not. You can just offer lower price, or you can ask for something else, that kind of thing. So in conclusion, for seller, you want to work with IP counsel to develop good IP portfolio, conduct your own diligence, and disclose as much information as possible to avoid some liability down the road. Consider priority and trade-offs as well. Buyer, obtain as much information as possible, and also work with IP counsel to conduct thorough IP due diligence, and also priority and trade-off as well. I think that's about it.
Okay, so it's open to questions for the panelists. Go ahead.
So I have a question. So when the economy starts to take off again, do you normally see a lag between that happening and VC capital happening? Or are they completely coming in soon?
Yeah, I think with the public markets in particular, it's very directly kind of correlated to the stock market, right? And so when you start to see the stock market take off, IPO market will heat back up again. VC capital and funding, a little bit different. It can kind of go hand in hand, but it's really, again, kind of tied to the IPO market. And when VC funds start seeing exit opportunities open up again and opportunities to get return capital to their LPs, and they feel like the environment is friendly enough for them to start extending capital again, they're going to start doing that. So pretty closely correlated.
So on the same lines, we all know, right, for example, AI, machine learning is all taking off. Yeah. We already know that. So I'm just trying to see if there are ways and means of kind of reinforcing that separate observation with the data you have. Meaning, we know consumers are tightening, retailers are tightening, but do you see evidence of increased AI ML services by them to, for example, it could be process saving, process costs, workflow costs, etc.?
Yeah, I mean, definitely AI. If you don't have AI as a part of your business already, you're dead in the water, essentially. And it doesn't matter what type of business you're operating. You have to have some sort of AI strategy built into it. Otherwise, you're just not really going to last in the long run, because a competitor is building in that AI into their platform, and they will win out at the end of the day. And that's where you're seeing, the one or maybe a couple shining stars in the VC market is AI and machine learning. That's where we're seeing a lot of investment dollars go into that. And so that's going to create an interesting dynamic. There's arguments over, whether it will be a net job destroyer or a job creator, time will tell. We'll see how additive or subtractive it is from the companies going forward.
Do you think AI is overrated right now, like a bubble?
Yeah, for sure.
Okay.
For sure. Definitely. I mean, like, it's very promising, but it's just like what we saw with every other bubble leading up to this, crypto, etc. Like, everyone's excited about it. There's a ton of potential. What that potential ultimately ends up being, TBD. It's still very much the wild, wild west, and you have a bunch of people placing bets, and that's what happens when you're in the bubble. People place bets, and because they don't know where it's going to shake out, they don't want to look stupid, and they want to have some CYA factor there for something that does pan out. And I think we'll continue to see that until the market is still frothy overall, and there needs to be a kind of resetting and recalibration across VC market in particular. There's still that disconnect, and AI is a big driver of that disconnect, I think, right now.
I know you don't have a crystal ball, but when do you think, if at all, this AI bubble is going to burst? When do you think that's going to be?
That's a great question. If anyone knows, please tell me, and we can do something together.
Your idea about it.
Yeah, I mean, I don't know. I think it'll be interesting to see. I think a lot of market dynamics are going to be driven by the Fed and fiscal and monetary policy, and what we see there, that may start to dictate some things just because of the trickle effects of that across capital and access to capital. That could kind of dictate when that AI bubble burst, but I don't know. It's hard to tell.
Gartner hype cycle.
I can speak a little bit about that. I'm handling AI computer medical test area. So we're getting lots of AI innovations based on medical image analysis AI or patients biological data analysis AI, and all sorts of technology area. It's very, very hot at least in IP.
Go ahead.
I have a question for Amy. So I have a question for Amy about especially PE acquisitions, right? So for instance, so instant brands, right? They make the Insta Pot, right? As well as they also bought Pyrex or whatever. So as soon as they bought Instant Pot, which was this great brand, this beloved product, sort of it's phenomenal. It does awesome stuff. First thing, okay, load up the company with a whole bunch of debt, right? So with 90 million or whatever, pay themselves a boatload of money. Interest rates go up, company goes under, right? So it means it can't survive any sort of a few quarters of falling revenues anymore. Chapter 11, right? Bankrupt, right? So and the point is that was unnecessary. So I guess my question is, from an acquisition standpoint, right? How do we kind of, what can anyone do to have, I guess, less of that?
So to make an acquisition more successful?
Well, I mean, the sort of, sort of private equity, that's happened a lot. That happened with Sears and Kmart. That happened with, with instant brands. That happened, so in a lot of cases where any time it's given private equity a bad name, right? So there's a lot of hype about it, and I know because I was at 4 Wall Street investment banks, I get that. The issue there is that if there's that represents agency risk in the sense that it's not really a fiduciary, right? Sort of a transaction, right? Because they're not sort of taking it over. The sort of stated terms of the deal, right? The acquisition are, well, there's synergies and all the stuff that you talked about. But in practice, it's like, okay, great. Here's some of this cash cow. We're just gonna load it up with debt. Pay ourselves a gigantic check. And because now so turn like full-on Gordon Gekko, right? Turn the company upside down. Sort of break the unions. Break all the pension plans. Break all the whatever. And then as soon as the economy turns down, the interest rates go up. Guess what? Company blows up. Can't support that anymore. How do we have less of that and more of acquisitions for actually the allegedly right reasons?
Yeah,
Greed is good.
That's a good question. A difficult one for me to answer. I primarily represent sellers, but that being said, Yeah, no worries. What percentage of businesses, do you know, what percentage of businesses fail that start?
65% fail within 5 years.
Yeah. So 65% of businesses that are not being acquired, that start from ground zero, fail. So I imagine, do you know what the statistics are for companies that were acquired?
I don't, not off the top of my head.
If I had to guess, I would say it's a lot smaller because you already have a company that's proven success, and that's why it's more attractive for a buyer to acquire a company as opposed to start it from ground zero. The chance of it going wrong is actually better. When it comes to acquiring a business, private equity groups have changed how they do things over the last 10 years. It used to be that they would acquire the company, they'd get rid of everyone, put in their own management, and then and see what happens and sell it after a couple of years. And I think a lot of private equity investors realize that that's not a great model, that there's a lot of failure when that happens because you're replacing all of the things that made the company great. And it had a proven track record to start with. So private equity groups now tend to hold longer, and they tend to be more involved in the running of the business and not just expecting it just to sort of do its thing. So I think that risk is being mitigated, even though you're telling me the stories that are maybe situations that were not successful. I'm sure that's still an issue. But I would say overall, I'm seeing more success with private equity groups in the way that they're doing it. So I don't know. Do you want to answer that perhaps?
Sure. So leverage buyouts that you're talking about, they're here to stay. It's been around for decades, and it's going to continue. That's the reality of it. Now, talking about private equities, private equity firms changing their ways, you have to think from a PE firm's perspective. They're looking to, or traditionally, their goal was to hold a portfolio company for about 5 years, right? And their goal was to extract about 20 to 25% in IRR. Now, when you layer in about, say, 90% of your cap stack with debt, which is cheap, right? It's cheap money. It's, now that we are in the 7-8% environment, a couple of years ago, we were in the 2s and the 3s and the 4s. That was what sort of, one of the factors why you saw the number of LBOs that occurred in 21 and 22. Again, I may not be answering your question, but the short answer is LBOs are here to stay. Private equity firms may figure out a way to do it differently, where they may layer in a cap stack that is more sustainable. They may layer in traditional debt that's about 65%, layer in mezzanine debt from their own fund. We have a couple of deals that we've done with a structure like that, where they roll in their fund, which is essentially pseudo equity, but they pay themselves a coupon because there's tax benefit involved, and they find a way to make the company successful. So, granted, there are situations where these over-leveraged companies fail, but PE firms have evolved, and they are completely, they understand the risks, and they've basically come up with solutions internally to mitigate those risks.
You talked about publicly held corporations, about 47,000 or so. How many private equity companies are there in North America? And maybe you could tell me how these are formed. What is the basic DNA of a private equity firm?
I actually do not know how many private equity firms there are in North America, but
just the US.
Yeah, I would not know that statistic off the top of my head. But how is it formed? Traditionally, what we've seen is, private equity firms generally evolve from a family office, and then a part of high net worth individuals basically invest into a fund. They pool resources together to basically form a closed-ended or an open-ended fund. So I'm not sure that there is a right answer to it. But
Only in San Diego.
in San Diego, the ecosystem is very small. I can tell you from the industry that I specialize in, there are probably 5 that we work with in San Diego.
Guys, the question for anyone, not bad. Need your advice for startup companies. There are some people here who are starting up new ventures. And I have served personally on many boards. And I'll tell you from my experience, when a new company starts, the founders get a lot of options and common stock. Then there comes a convertible note, and the convertible note converts into preferred stock. Then there's another series of preferred stock. At the end of the day, the board is controlled by preferred guys. The founders are left with the common stock, or they're booted out with a new CEO. And when the company is sold, typical deal structure ends up with 95% of money going to the preferred stock. And common stock people founders are totally screwed. What advice would you have for the founders and entrepreneurs so they don't end up in a situation that all their hard work ends up in nothing?
Get a good attorney.
Yeah. Actually,
That's a great question.
very good question. Yeah, the way that we structure our fee, we only fee on the cash that comes in the beginning and depending on, in a note and a couple of other parts of the deal structure, but what we don't fee on straight away is the earnout. So I'm quite familiar with what happens with the earnout, and you're correct that usually when it comes time to collect on the earnout, it's not achieved. A good portion of them, I would say, that your experience as well.
Yes and no. I mean, there's one deal that I'm working on right now. The earnout is due in P6, which is June, and surprisingly, they did on the. So they did perform, but it was also within the QSR space, which is the fast food restaurant space. What we've seen in the fast food space is that with the consumer spending sort of going down, they have been trading down, so to say. So the same-store sales within the QSR space has continued to go up. Again, that has worked well for the plan.
I would say that entrepreneurs are by nature optimistic, and that comes into play in the earnout. We think, okay, yeah, it's definitely going to earn $5 million next year. Yeah, I know it only earned $1 million this year, but we can get there because the sky's the limit. And so if you're selling your company, I would say that an earnout, it mitigates the risk for the buyer, and it puts more of the risk on the seller. So, and I deal with some of the small, I think I probably deal with smaller deals than you. So we try to get as much of the deal in cash at close as possible, and also negotiating so that with an earnout you don't have, it's not like if you only achieve this amount, but a certain percentage if you achieve a certain amount, and a certain percentage if you achieve something smaller than that, so that you at least get something in the earnout. If it's not a cliff, that's something that we recommend for our sellers. Yeah.
So do you have anything to add from a legal perspective on this?
That's actually for corporate lawyer. I'm an IP lawyer.
I will say though, I was half joking about get a good attorney, but in all seriousness,
Yeah.
get a good attorney. That's like first and foremost. And then also read your deal terms. Like when you're out there raising capital, it's easy to go for just the highest dollar amount, highest check amount, right? That's not always the best outcome. You got to look at the actual deal structure and really get in the weeds and get into the nuances, because that's what actually matters. That's what affects your ownership percentage. You got to look at liquidity preferences, all those sorts of things that go into the deal to figure out what's the best deal for you. It might not be at the highest valuation, the biggest check size. That might not be the best solution.
Is it?
I just wanted to add on to.
Suggested, I don't know if it's working or not, put some kind of conditions in your bylaws. Some kind of protection clauses in your bylaws for the common shareholders and funds.
Yeah, that gets into the legal nuances that I would.
It's illegal?
Yeah, I don't know if.
I tried it once.
Yeah? Did it work?
Leading into what Tyler just said, I would say hire an attorney and also an investment banker.
And to add on to that, an M&A attorney.
I always say don't go cheap on lawyers.
Yeah, not your best
Don't
friend
go
is a
cheap on
lawyer.
investment bankers. You'll pay a price in the long run.
I have two questions, one for Amy and one for Mr. Heungsoo. So first, so what are some interesting lessons learned from a negotiation perspective, right, during the course of your experience, number one? And for you, what's an average engagement, IP search? How much would it typically cost? Just an average. I know it's a loaded question, but those are two questions I have.
Repeat the first question.
Are there any interesting negotiation strategies you learned during the course of your deals? Any lessons learned we can take home?
Yeah. Don't say no to an offer. Well, actually, I'd like to hear what you say about this as well. Yeah, don't say no to an offer. Hold the offer for a while before you say no, because I think, especially in the beginning when you receive a handful of offers and you think, okay, I want this one, let's say no to these. Often what happens is when you start working with buyers, you start unpeeling the layers of the onion and starting to see that it's rotten inside. And so having the other offers and maintaining the relationships with the other individuals and companies is extremely important. Keeping them, sort of as smoothing it over as best possible so that you have options. And also, I think it's important to know what you want. I think that's a really important and I know that doesn't sound like it's part of the negotiation, but it really is.
As a seller or as a buyer?
As a seller, yeah. Knowing what you want. Like, do you want to stick around? Are you open to an earn-out? Are you done and do you want to get out? Do you want to just take cash and go and have the shortest transition period as possible? Is the legacy important to you? Know exactly what you want when you go into it, because then you know what a good deal is when you see it. And that is, interestingly in my mind, I think that's part of the negotiation. It's part of knowing how to find a good deal.
I would agree with that. If the goal is to extract top dollar from the buyer, I can give you a very interesting example from my own personal experience. That there's a restaurant that we are selling. The buyer basically, bid at a certain level. Seller was not very happy with it. The one interesting fact with the restaurant space is that they operate on something called as working capital deficit, meaning they use today's cash to pay yesterday's bills. So their current ratio is always negative. Now, we were able to structure the deal such that the entity will continue to function on a go-forward basis with negative working capital, which extracted additional value for the buyer, and it was at no additional cost to additional value for the seller, but at no additional cost to the buyer. In this situation, we were able to extract about $4 million for the seller. So no offer is a bad offer until you put math to work.
So for prior search or validity search, it's less expensive. I would say $5,000-$6,000 because you have a reference pattern that you can search. for landscape search, it can be expensive, usually about 20 to 25K, because you have to search a variety of patterns and then compare.
What is the typical time to complete this transaction from the time you engage the seller? Is it 6 months, a year?
On average, it takes us about a year, sometimes quicker. I had a record sale, went under dual sign LOI in November and closed by April, and that's the quickest I've ever seen.
What's the most consuming time element? Is it about finding the buyer or finding?
It depends on the deal. I have another deal that just closed last week, and that took 2 years. That one, they had oil and gas as an end market, and it's a lot of investors right now are avoiding oil and gas because of the ESG sentiment. So it took a really long time to get buyers to the table, and then the due diligence took a really long time as well. It depends on the complexity of the business, and whether or not you have a good CFO, or if you have financials that are clean versus ones that need to be reviewed. Quality of earnings can take quite a bit of time. I have a deal right now that was under LOI in October, and they just finished QOV last month. It took that long, so it depends. Every deal is so different. It's really hard to know. It depends on the industry. I mean, on the flip side, we also had a company in the medical coding industry. We had so many NDAs coming in. This was a month ago. We had to stop advertising because we had so many come in. He had 10 offers, and the seller asked us to stop because he said it was too confusing. So those kinds of deals happen really quickly. When a deal is very, very small, it goes fast because usually the buyers aren't as savvy. And when a deal is very large, it tends to go a little faster because you have savvy CFOs and individuals that are making sure the financials are clean. But the ones in the middle can be tricky.
Does anyone of you work in the VC space, like taking ownership in a startup, or is it mostly just buying and selling?
I only deal with privately owned, usually founder-owned businesses, and primarily selling for retirement.
Yeah, my client base is primarily portcos of VCs. We interact with VCs, on a quasi-regular basis, but they're not our ultimate client, nor are we actually buying or making investments in companies. We just deal with their portfolio companies.
Does JP Morgan have a VC fund or a VC arm or not?
We do. We have a bunch of different pockets of capital. Some of it is more towards more private equity style. Others is more traditional kind of VC dollars. A lot of times too, we will do strategic investments or strategic acquisitions when it's like a fintech or something like that has an interesting or compelling product. So we have anything and everything you can imagine at JP Morgan. It's kind of ridiculous, but yeah, there are little pockets.
In San Diego, or is this primarily San Francisco?
Primarily New York is where most of them sit. 23 Wall is our kind of VC-ish arm. Most of them are in New York, but they tend to travel and make investments all across the country.
Okay, I have one question for all of you. There's 2 things that you would say to an entrepreneur to avoid.
Don't go for the top dollar. Look through every single agreement, every single document that comes your way, and analyze everything.
2 things or 1 thing?
2 or 1?
1 or 2, okay. I would say don't ignore the need for an exit strategy. I think sometimes it's hard to imagine, thinking of you're so busy as an entrepreneur doing your day-to-day, and it's easy to kind of put it kick the can down the road and not think about your exit strategy. But every person in this room is going to exit their business, whether you want to or not. You'll either be carried out or you'll do it on your own terms. And you want to do it on your own terms. So, don't, yeah.
You get a good IT attorney.
Yeah. I studied the attorney and then build a good IP portfolio. And also probably work with a good corporate lawyer as well to make your business successful.
So I would echo everything that everyone else has said. In terms of some more specific things, I would say on the exit strategy, you want to start early, earlier than you think. 18 to 24 months out is generally when you want to start thinking about it. And then the other big thing that we see happen time and time again with founders is don't forget about yourself. If you're going into a large liquidity event, make sure you're talking to someone, some sort of private banker, wealth manager, wealth advisor, to think about all of the potential tax implications that you may be facing. There's a lot of them, and if you don't structure it correctly, you're going to pay way too much money to the government, and I know everyone does not like doing that. So, little plug for over there. You're welcome. Yeah, that's about it.
Tyler, do you want to touch a little bit maybe on QSBF exception?
I would love to, but I am way over my skis on that. So, I'm sure someone else around here could probably talk to you about that, but I just don't know enough on the nuances. But very important thing to consider. I do know that much.
Thank the panel for a very informative session, and we've learned a lot. Hopefully we'll see you again for some other